Obama administration today announcing a homeowner bailout, $3 billion being made available to those struggling to pay their mortgages because of job loss, reduced income, or medical conditions. Right now, we have an exclusive Bloomberg interview from Washington. Herb Allison, Assistant Treasury Secretary for Financial Stability, joins us for more on these latest foreclosure prevention programs. Herb, great to have you here. Part of me says that's a good thing. We're helping out some struggling Americans. Part of me says enough is enough from the government. We've already put out too many billions. We're seeing extreme deficits. How can we do this?
Well, Carol, this money has already been committed. That is the Treasury portion, which is $2 billion. It's part of the TARP program, and it's part of the $45 billion that's currently allocated to housing issues.
Is this, Herb, do you think this is the best solution on the table right now? Because we've heard of a number of other programs that may not involve the phrases extend and pretend and pray and delay, which I'm sure you've heard numerous times. We have a lot of guests on the show saying that's not a strategy, and that really seems like that's what this is.
Well, what we're doing here is helping people who are unemployed really through no fault of their own because of the recession. They're homeowners. We think it aids financial stability and house price stability and neighborhoods if these folks can stay in their homes while they're looking for a job. So the idea is to tide them over with a declining balance loan, zero interest rate, while they hunt for a job. And that balance declines over time as they stay in their home.
But isn't it the kind of thing, though, that artificially inflates prices or holds them up? I mean, I know you want to stabilize things and you want to engineer a soft landing if possible, but wouldn't it be best for everybody involved if we can just get to the bottom and then start to work our way back up from ground zero, so to speak?
Well, actually, Matt, these are people who we expect to stay in their homes. They've lost their job temporarily. Sometimes it takes months in this recession to get a new job. So the idea is to keep them stable in their current housing, and once they have a job, they'll be able to resume their mortgage payments. You know, they also may be eligible. Go ahead, Carol.
No. Please finish, Herb.
They also may be available for one of our other programs, like the housing mortgage modification program, so they can receive a more permanent reduction in their mortgage payments.
What I wanted to ask you, Herb, is we did some digging. You know, Fannie Mae's Home Saver program, that offered bridge loans. It had disappointing returns because so many of the loans were never paid back. So what confidence do you have that in helping these homeowners that those loans will ultimately be paid back, or no, it's another thing kind of on the back of all of us U.S. taxpayers?
Well, when we first set aside money from TARP for housing, we didn't expect to get that money back, unlike the money we invested in banks and some insurance companies and the auto companies, where we're working hard on behalf of the taxpayers to get our money back. And so far, we've made a profit for taxpayers of almost $25 billion on the investments in the banks, for example, and we've received back 75% of the money that we invested in banks. But this program's different. This is to aid people in being able to stay in their homes during a deep recession, and as economic conditions improve over time, they'll be able to continue paying their reduced mortgages going forward, their reduced balance mortgages. So we think this is good for stability. We think that this is something that not only helps those individuals, but helps their neighbors, because as we know, if someone loses a home to foreclosure, the prices of all the houses in the neighborhood fall, sometimes by thousands of dollars.
If these are people, though, who are going to stay in their homes, you got to assume their mortgage payments now are the same as their mortgage payments before. We're not talking about mortgages that reset here. What's to convince you that they'll continue to make the payments once they get through this time of hardship, or once they burn through the $50,000? I mean, aren't these people going to just not be able to afford the mortgage payments going forward because they have indeed lost their jobs?
Well, people who have incurred reductions in income, either due to illness or unemployment, for example, may be eligible for our Making Home Affordable housing mortgage modification program, in which case they get permanent relief on their mortgage payments. So if they have suffered a hardship, if it's unlikely that they'll be getting out of that situation anytime soon, they may be eligible for a permanent mortgage modification. On top of that, some of them may be eligible for this program, the hardest hit program.
Are you concerned that a lot of these people will come out of the other side of this seriously underwater in their mortgages, meaning they still owe a lot more on their homes than they're worth?
Well, we've seen in some areas of the country that there have been substantial reductions in house prices, and there are a lot of people underwater in their mortgages. And that's one reason why we introduced two programs, actually. One is the first round of the hardest hit funds, which went to states that are most impacted by falling house prices. As I'm sure you know, the underwater mortgage situation is highly concentrated. For example, two states, California and Florida, account for 50% of all the underwater mortgages, and 5 states account for 75%. That's why we think there's a need to focus some of this assistance on certain parts of the country. This is not only a national problem, it's very heavily a local problem, as is unemployment. And that's why we're allocating these funds to the states with the highest rates of unemployment. So we think these are sound policies to help literally hundreds of thousands, maybe millions of people get through this recession with their housing intact, or helping them to move toward more affordable housing. But we have a range of programs designed to individual situations and especially local situations.
You know, Herb, and forgive me if this sounds insensitive, because I do feel for those people who are out of jobs, unable to hold on to their homes. But, you know, we've seen when the government gets involved in housing, it certainly hasn't played out very well over the last couple of years. My fear is in another year or 2 or 3, we're going to be reading about these people we helped out with these $3 billion that they lost their homes anyway, and then it just didn't work out. I mean, don't you see it playing out that way, potentially? Actually,
Carol, what we see here is a unique and innovative program, or set of programs. In the past, you're right, when people had their mortgages modified by servicers before 2009, they often ended up with higher payments and even less ability to afford to stay in their house. And that's why there was such a high default rate in those mortgage modifications.
Okay.
In the case of HAMP, what we're seeing is we're permanently reducing their payments substantially, most cases on average $500 a month, and we're seeing much better early results on defaults.
All right, we got to run. Herb, great to get some time with you. Thank you so much. Matt and I appreciate it.
Thanks very much, Carol.
Herb, Allison, everyone.